Let's bring in Saira Malik, Chief Investment Officer, Head of Equities and Fixed Income at Nuveen. It's so interesting, Saira, because the inauguration is not even until January 20th. My first question to you is going to be, Mike just showed how much the financials have already moved based on prospects for a different administration. Are these trends going to continue, or have we seen most of the move already in a lot of the things that could be impacted by a new administration?
Well, it's the backup in the 10-year yield that's pouring some water on the Trump trade. Markets are looking at three factors here: taxes, tariffs, and deregulation. And the concern is, how is that going to impact the deficit economy and inflation? So first of all, we'll get CPI shortly, and will all of these enactments cause inflation to be more sticky? Also looking at the deficit, is this going to cause the deficit to increase, or will these new appointments of Elon and Vivek be able to offset? And then for the economy, if it causes it to overheat, then we're going to see less Fed rate cuts next year. So how are we thinking about markets? I think two things will continue. First of all, markets will continue to broaden, so that's going to be important. We're going to move a little bit more away from probably technology stocks leading, but we do need to consider valuations here. The S&P 500 is currently trading at about 22 times forward PE. If you look at the last quarter century, the last time we were higher than that, March 2020, when the S&P was at 24 times. So we definitely have pulled forward some of this trade, and markets are not cheap.
I actually said that at the top of the show, that, I wouldn't want to come in at 23 times earnings as a new administration necessarily. And you said, will the economy overheat? Isn't the range of possibilities from overheating to actually slowing? If you were, Elon Musk has said, if we do what we'd like to do, there will be some near-term pain. And I think he's talking about for certain sectors of the economy, if you pull in a lot of, the government supports a lot of parts of the economy, not necessarily the best use of capital, but it just is a fact.
Well, sure. Decreased government spending can have an impact. Also, tariffs can have a wide range of outcomes.
And tariffs.
That could cause a slowdown in the U.S. Tax cuts, of course, positive for consumers and corporations. Deregulations positive for M&A. I think there is one area of the market that still looks cheap to us. It's small caps, though, trading still at about a two-decade low versus large caps. And all of these initiatives will be positive for small caps. More M&A will be positive. More domestic consumption because of tariffs, because of tax cuts. All of this great for small caps. And we probably aren't going to get 5 rate cuts by the end of 2025, but lower rates, of course, we will get some of that, and that'll be positive for the small caps and their debt.
How much is already paid forward in small caps? What have we seen in the last 3 months?
We've seen a little bit of a rebound, but they're still at these very cheap valuations. So there's companies we like Addus Home Care, which is a play on demographics and aging, and home care, which is less expensive than hospital care. Lumentum, which is a optical photonics play that is a positive play on data centers, and AI, that's another company that we like. So there's these great little small companies still trading at discounts to large caps. I think that's where you want to be fishing to get some exposure to the U.S. at good valuations.
Could there be a time where people that own large amounts of bonds, the vigilantes, where they say enough is enough, is 4.5? It is. If the deficit looks like it, if he does cut taxes, if he followed through on every one of those promises of who's not going to be taxed, and then continues the defense buildup and cuts corporate taxes, isn't all that going to add to the deficit? Does there come a time where enough is enough, or does that never come because we're the reserve currency? I
think there is a time markets get concerned. You saw last year where the 10-year hit about 5%. That was concerning across equities and fixed income. And fixed income, you need to be selective. So we like areas like leveraged loans, which are a little bit less dependent on the degree of rate cuts that we expect. But I think bigger picture, though, it's not all about overheating. We'll be watching closely the employment markets, and payrolls last month, of course, coming in plus 12,000. We blamed it on strikes and storms, but need to watch payrolls. I don't think the September plus 254 was a sign of a very strong employment market. It's coming back into balance. So that wide range of outcomes and where this economy may be is still uncertain. Employment's slowing. The consumer is very dependent on the high-end consumer. So, we may see, the economy actually more balanced than we think, and may not be as overheating as much as investors are concerned about.